Good morning, everybody. Give it just a few seconds for everyone to trickle in. All right, I still see folks popping in, but let's go ahead and get started. Good morning. Welcome. My name is Michelle Conley. I'm the Senior Director of Partnerships here at World Trade Center, Utah, and grateful to have you all join us for May 15th iteration of our weekly trade and tariff webinar. As most of you probably know at this point, we host these every single Friday and have for over a year to help provide guidance to you and your business on how to handle different situations going on with trade and particularly tariffs. These sessions are recorded, and you can find this one and all of our previous sessions on our YouTube page, which you'll see a link in the chat momentarily. We also, really encourage questions and discussion so that we can make sure we're addressing your specific issues. So feel free to use the Q&A function throughout to ask any questions or bring up what's on your mind. We will, of course, start with my colleague Ben Collender, but then after that, I'm really excited about our guest today. We'll have the opportunity to welcome Ryan Wang, who is an SVP and senior economist for the U.S. market at HSBC. Of course, HSBC is a huge international financial institution who we have the pleasure of working with here at World Trade Center, Utah. I want to thank a member of our Global Advisory Board, Joni Jensen, for making this connection and setting us up to hear from Ryan today. So looking forward to his remarks. And again, please feel free to ask questions as he is speaking. But first, to kick it off, we will hear from Ben. What happened this week, Ben?
Yeah, thanks, Michelle. I'm going to share my screen. We've got a lot happening this week. Let's see, here we go. All right. So to start with, as always, um, can everybody see the dashboard? This is our tariff dashboard. By now, everybody should be familiar with it, but if you're new, you could go to wtcutah.com/tariffs and follow along with me, which may be useful in today's session in particular, but I'll walk through real time some of the things that we're going to be talking about. Um, it also has a link, as always, for these webinars. So if you want to share it with others who may benefit from this information, you can do that as well. So the first thing we want to address today is just the ongoing situation with the IEPA refund. So we've got a lot of folks in our business community who have applied for the refunds and who are awaiting or possibly maybe even have received refunds. If you have received refunds, let us know in the chat. Send us an email. We would love to hear from you and just get a handle on that. We heard I think it was a 45 to 60-day window, if I recall correctly, in the customs CSMS release that set expectations like when you apply, you can expect this long. So that really hasn't crossed yet, but we're seeing a lot in the press about refunds happening already. And so just curious if our business community is seeing those. But as the refund process takes shape and more companies apply, we're a resource to our business community to have this webinar, but we also shamelessly promote other good resources and bits of information. We know businesses have limited time, but if you're having a particular issue that you want to go deep on, we want to make sure that you have the resources necessary. And Customs this week released a series of webinars, which we have as a top link right here on our webpage. So you can click this, go in and see where these webinars are. So Customs will be having a webinar on duty refunds on Wednesday, May 20th at 1 p.m. And we'll also have one on Cape claims on Thursday, May 21st at 1 p.m. So we've covered both of these pretty extensively in our webinars in the past. However, there is, Customs will always have interesting things to say that may go beyond what we're saying here on this webinar. So be sure if you're having issues or have questions that are more in depth or that you're just interested in going deeper on the topic, those webinars are great resources for you to do that. Also, I want to give a shout out to our local our partners at Dorsey. So many of you may know Troy Keller. He fills in for me on the dashboard when I can't be here. They do a great job on all things tariff related, and they're doing a webinar on tariff refunds. And we'll drop a link to that in the chat as well. It's on Thursday, June 11th. So for anybody who's interested in having a lot of deep conversation, legal focused on the refunds, particularly what claims are possible against importers who receive IEPA refunds. This has been a big question going on right now. They're going to be covering that on their webinar. And so something to pay attention to. We'll drop it in the chat. And with that, we'll move on from other webinars outside of this one and go more to some of the tariffs on our dashboard and some of the updates there. So pharmaceuticals, this 232 that was put in place some time ago, the Federal Register had a notice go out this week that if you're involved in the pharma industry and you're a company and you're looking for an onshoring agreement to get those reduced tariffs, it just outlined a process. You'll want to apply by June 12th is the date in here that you'll want to apply as a company to receive those reductions in tariffs. If you are considering that, the link is on our website, and you can click that and walk through the steps to apply for that reduced tariff. So if you're in the pharmaceutical industry here in Utah, you want to pay attention to that. The next the next update, and this is maybe the bigger news for the week, is there's been if you've missed it, you've been under a rock. Trump has in China this week, having ongoing dialogue with China and what the trade situation, the security situation looks like between our two countries, and so. Those talks began this week in Beijing and concluded this morning. We hope to have more content on that in the near future. But for now, we're just monitoring some of the trade situations and what we saw some comments on soybeans, of course, and a few other things, but nothing concrete that's new so far. But I'm sure that will come out a little bit more in the coming days, and we can be prepared, hopefully next week, to have more detailed trade information on that topic. But one of the things that everybody should be paying attention to are the 301s that were originally initiated in 2018. But there have been several modifications, list extent, either exclusions or additions since that time. They're going through their second 4-year review. And so this is part of the procedural process to consider what items will be tariffed, maybe clean up the exclusions list or look at both of those. And so that process just started, and there are two lists that are going out for public comment. One is the July list and one is the August list. And so the July list is open for public comment now. You can click that. You can go in and start to dive into those details. But if you're importing goods from China and you're facing either tariffs on the 301s and you shouldn't be, or you think an item should be included, provide comment. So USTR is we comment on this all the time on this webinar, but essentially providing comment gives you some legal recourse down the road if you do want to say, hey, I wasn't heard, I put in something into the Federal Register or into public comment through USTR. And this is a consideration that has to be listened to. It's not being listened to. It at least gives you a pathway to have that conversation. Whereas if you don't provide comment, you can face challenges there, and it may not be considered. So the last thing, and this is also a huge one, there have been so many updates this week. And sorry, Ryan, I'm taking all the air out of the room here for all these updates, but hopefully, um, I can be quick with this one. So the 122 tariffs, we're all tracking these as well, 10% on a ton of goods. We updated last week that these tariffs were deemed illegal, at least for the two cases brought before the Court of International Trade. And those we we were here with Phil last week talking about how, well, there's going to be an appeal by the US government. Sure enough, that happened. So there's a hold on that decision right now. And the US Appeals Court paused that decision. So these tariffs are still in place until July 24th. And the decision that on these 122 tariffs again was only decided in these two particular cases that came before the Court of International Trade. It wasn't a broad decision that impacted all companies. So when companies are considering, well, do I file now? It's like, well, the US appealed that decision. The tariffs are still in place while things are being weighed, and we'll keep our audience updated with those further developments as they become available. And lastly, we are still tracking some things that we don't have technical documents for, but we assume either they're going to come out or they're going to drop off here in the near future. And it's the Scotch whiskey that came from the visit from the King of England. We've got the King of Britain, the 301s. We'll continue to track those as formal documentation comes out, and then the 50% tariff that has been discussed on countries supporting Iran with their efforts. So that is a lot. You guys heard from me a lot this week, but those are the updates that we are tracking at World Trade Center, Utah.
Thank you so much, Ben. Super informative and helpful as always. And yes, as you mentioned, of course, the China summit happened this week. Next Friday's webinar will solely focus on the results of that and the impacts on trade. So join us for that. And then we will in a few weeks have someone speaking about the 232 tariffs for pharmaceuticals. So stay tuned for that as well. But now let's let Ryan have some time to give us some updates from HSBC's perspective and share some of his expertise with us. So Ryan, thanks again for joining us. Welcome.
Yeah, thanks so much, Michelle and Ben, and yeah, it's a pleasure to speak with the group. And just to introduce myself, I am HSBC's U.S. economist, so I focus on the macroeconomic state, specifically on the U.S. I'm part of a global team, so we have coverage of global economies around the world. We have a trade economist who focuses on trade-specific issues, but I often focus on those top level broad-based macroeconomic statistics like GDP growth and what's going on with prices. We had some inflation numbers earlier this week. Also, what's happening with the job market. And those are kind of some of the main areas that I tend to focus on. Well, this is a very good time actually to be talking about, trade from a U.S. perspective. Again, from a top level, maybe not so much of the practical information that you just heard from Ben and that will be there in future sessions. But basically, we're a little bit 1 year after Liberation Day, and the trade data has kind of just catched up, right? I think we have official trade data through March, so it's a nice time, 12 months of data since that period, and of course a year of data on other economic statistics. Let me say that specifically, if we talk about the trade deficit and just big picture, that of course that was one of the planned goals or objectives of higher tariffs from the perspective of the Trump administration. Well, the trade deficit over the last 12 months through May has ended up at about $1 trillion. So it's still quite large in that sense. But if you scale that as a percentage of GDP, the trade deficit is about 3.3% over the past 12 months. And that is a bit smaller than in the 12 months prior to that. And it is also one of the smaller trade deficits that we've seen over recent years. Not massively so, but a little bit more of a narrower trade deficit. And I think there's a pretty clear reason why, and that's mainly relates to, I think, all the front loading that we know occurred in the first quarter of 2025. And so in the remainder of last year, the second through the fourth quarter, imports did not collapse, but they dropped back, as you might expect. And so I think that's one of the reasons. So I think, just objectively, if I'm taking stock of the data, I would say over the medium term, I don't certainly expect the trade deficit to narrow to zero or to get into a situation where imports are the same magnitude as exports. But it is interesting to see what's happened, and we'll keep an eye on those data going forward. Now, another major objective, of course, again from the Trump administration's perspective, would be to promote manufacturing employment, manufacturing production, things like that. And actually, we just had some numbers this morning, official industrial production data, which does include manufacturing output. And it did actually grow a bit. There has been some some growth over the last year. Again, perhaps not super strong, but I think industrial output has grown by a little bit over 1% over the past year. Now, tariffs are just one part of that picture, of course. There's many, many reasons why the manufacturing sector is doing what it's doing. And then on the employment side, of course, if you're looking at a multi-decade period, manufacturing employment is still very low compared to previous decades. But again, I wouldn't say it's kind of performed in line with other sectors from a labor market perspective, maybe even a little bit better. So I would say kind of a mixed message, not so clear. Let me turn to this final point that's, again, related to tariffs, and that's on the inflation side. So I think that, if you look at the perspective of consumer prices, and that's what the Fed has been focusing on, they recently have been highlighting an analysis done by some members of the staff at the Fed that really tries to dig down into the different types of consumer spending, both on goods and services, and say, well, how much are imports really important in those different products that are consumed by households? And therefore, and they did very careful tracking of tariffs ups and downs, all the successive waves of tariffs last year, which of course there's so many. You can't really, it's basically impossible to say, okay, this tariff led to this impact on prices because they came so, in such waves so quickly on top of each other. And of course, as Ben just highlighted, towards the end of last year, actually, in a way, we had decreases of tariffs, right? Because we had some reductions of the U.S. In the China tariff rate, let's say, and some other reductions as well. So that also further complicates the picture. Anyway, the conclusion of this Federal Reserve analysis is that current consumer inflation rates may be being boosted by about 8/10 overall. It's actually more than that if you just focus on goods, because tariffs are primarily a goods, of course, they're on goods. But just in terms of the overall inflation numbers, 0.8%. So actually, the official data currently say that core inflation, and again, this is another one of these technical things because obviously we've had this surge in energy prices, but you take out food and energy prices and focus on this quote unquote core measure, that's currently running at 3.2% over the past year. And essentially, the Fed is saying that maybe as much as 8/10 of that can be due to tariffs, and that actually, if you wait long enough, that effect should gradually recede. Now, of course, it won't mean that the prices return to where they were, but it means that if we assume that tariff rates are not going to substantially rise going forward, and of course, that's subject to all this uncertainty that Ben highlighted with, of course, Section 122 and Section 301, and what will there be attempts to make to replace basically the replacement with the Section 122 already being the replacement. Anyway, lots of uncertainty, but still, the Federal Reserve, I think, is hopeful that the tariff impact on the inflation numbers will be smaller a year from now than they are today. And that's very important because we're getting another price shock in the form of higher energy prices that I just talked about, which of course stems from the war in the Middle East. So that was kind of interesting. So that was just kind of quick rundown of some of the numbers. Let me just take an even further step back and talk about those two macro elements that I mentioned. So what is overall GDP growth in the United States doing? Well, I would say it has been running at 2%, maybe even above 2%, if you just look at the numbers over the past 4 or 5 quarters. So that's pretty strong, pretty resilient, let's say, in the face of lots of different possible shocks and uncertainties. I will say that a significant part of that growth rate is clearly being driven by AI-related investments, right? Not necessarily anything to do with the usage of AI, but the investments that are being put into place, high-tech equipment investments, into data centers, certainly software investments, and even just sort of a rough cut of the GDP data can say those categories are growing so much faster than normal that maybe they're contributing a full percentage point to the growth rate, which is a lot. It's almost half of the GDP growth that I've been talking about. Depending on how you look at it, a lot of it is also imported, right? A lot of the 1% investment activity is partly imported. So some of it is being produced, of course, abroad rather than in the United States. But still, the demand is clearly there and has stayed strong up until this point. AI, as I'm sure we're all well aware, of course, also has been a very important, well, I just mentioned it, a very important tailwind for trade flow as well. So I think that's helped support trade. So yeah, so as I said, or I should say, a lot of things I mentioned, or I mentioned the Federal Reserve I'll just conclude very quickly. This is not about trade, but we do have a transition that's going on at the Federal Reserve, and of course that could have relevance for interest rates. I'll say my own view, and I've actually had the same view since the beginning of the year, is that the Fed will not actually make any changes to interest rates. And now I have to say, like the caveat is on both sides, because the markets are wondering about both rate hikes and rate cuts because of this inflation surge that's occurred. So I'll just maybe just leave that there as a possible strand that I'm happy to pick up on. But my own view is that the Fed will not change policy rates this year, actually not next year either. So yeah, maybe I'll turn it back to Ben and Michelle, and happy to answer some questions.
Yeah, so while folks think of their questions, I definitely have one I want to ask, but I want to say thanks to Dane and Jocelyn. Thanks for letting us know people are starting to get their refunds back in, so that's great news. Appreciate those updates. We may end up reaching out and asking for more details if you'd be willing to share just anything that you did that helped to move that along quickly. And I'm sure it's just uploading into the CAPE system and following the steps, but appreciate you guys sharing that. Um, so one of the questions I have is, a lot of what we do on this webinar is, we've got companies just from the start, after Liberation Day, standing this up, getting the information to local companies. There are a few themes that really play out with our Utah businesses. And one is, crystal balling, let's call it, is like how far can we look into the future with some quality data and expertise to say, look, you can't predict everything with exact certainty, but where can we make some educated guesses as a business? Because we still have to keep moving forward and going on offense with all of this turbulence going on in the trade world and in every other part of the world, whether it's war in the Middle East or what have you. I'm curious in your data that you were outlining, or the data, not your data, the data, as you're looking at particular industries. So you mentioned AI and energy, of course, in terms of inflation and investment and whatnot. But I wonder if you see certain industries growing particularly well out of this, maybe or really suffering in an outsized way, or maybe some trends that maybe they were suffering and now they're coming out of it, like those sorts of insights. What strikes you in the data that says, if you're a company in this, it may seem bleak now, but it's not, or if you're a company in this field now that it seems great, it may not be in the future. Just insights like that from the data that you're seeing and from what you are closest to every day. I'm curious, Ryan, what your perspectives there are. That was a long question, but just trying to paint some context on what some of what we've heard from our audience.
No, thank you so much for that, Ben. And that's thank you for that detailed sort of question. One of the narratives that comes up a lot in my world, and of course, it's not just in my world, it's sort of something that you hear about a lot in just the newspaper is this idea of the U.S. economy, broadly speaking, having this kind of this K-shaped dynamic to it. And usually, I guess originally that economists were talking about that in terms of consumer spending, right? Talking about consumer spending being still very much supported by higher income, higher wealth households, and of course the accumulated inflation over recent years causing more strain for lower income households, lower wealth households. But I'll also say that the job market, I kind of glossed over this, has been confusing, but generally speaking, the unemployment rate is still very low. It's actually at 4.3%. And so that means that wage growth is still progressing. It's not as fast as it was a few years ago, but there's not a lot of outright layoffs going on. We saw that right through the most recent data, still very, very low by historical standards. And wage growth is running at about 3.5 to 4%, which is actually kind of a normal level of wage growth. It's not super, super rapid. I think it shows that firms and workers have kind of like equal bargaining power in the job
Mhm.
market rather than it being really imbalanced. So that causes some trends. I think one of our analysts described it even like a kind of like an E-shaped economy where the bottom end is being supported so far by this job market that is it's not recessionary, or at least I wouldn't describe it as recessionary. Now we have all these, lots of economists have fears about what may happen going forward. Some of those fears are actually related to AI. But I would say that there's other divergences, right? So clearly this AI tailwind is very important. It kind of feeds into the other narrative too, right? Because you have all this investment going that's occurring, and then also you have a buoyant stock market, and there's definitely a connection between the two, and that's feeding into what economists would call wealth effects. And meanwhile, it kind of feeds into this other side of the equation, which is, basically the story I told was one where interest rates won't fall, right? They'll kind of remain at best where they are. That refers to both the shorter term interest rate that's directly controlled by the Federal Reserve, but
Mm.
also longer term interest rates. Actually, the 10-year U.S. Treasury yield is is almost at 460 for 4.6%. That's actually up about 10 basis points today. And that's important, right? Because that affects business borrowing costs, but it also affects the housing market. So it's not that I'm super negative about the housing market, but I guess I would say, like when we came into this year, a lot of economists did think that we would get lower interest rates this year, right? And that would be something you would hope for. And now it's not so, it's pretty clear that's not happening anytime soon. And it may not even happen at all this year. So then mortgage rates will kind of just stay where they are. Home that will tend to restrain home sales a bit, or at least not allow for an acceleration. Um, so yeah, there's different trends on the manufacturing side. It's got a little bit, like I said, more of a mixed story. Um, and to your point, we're still waiting to see how some of these future tariff rates will evolve. The Section 122 rates, many of the exemptions that were there for the IEEPA tariffs are, of course, still there. So there's still, I mean, there's still these smaller pockets of uncertainty. I say smaller relative to last year, I guess, right? It's not that we're expecting these big seismic changes necessarily to keep coming, but there are still questions to be answered, even on the tariff side.
And just one quick follow on, speaking of the tariff side, um, it's got to be tough as an economist because you've got the tariffs that hit and provide the shock, but then you get the refunds, for instance. How are you seeing that in the data? Is it just, um, yeah, how does that show up for you in your analysis on the impacts of the tariffs?
Yeah, that's a very good point. And I also this is also actually something that I wanted to mention, but I kind of skipped over, which is that the revenue side for the federal government,
Right.
and of course we have seen those revenues drop a little bit since the Supreme Court ruling, and so basically I would say they're still running at about a little over 20 billion per month, which is
Mhm.
substantial. That's much higher than 2024, let's say, when we had kind of monthly tariff revenue running sort of closer to 5 to 10 billion per month. So it's still double or triple that rate. But the peak for IEPA for tariff rates was around late last year when it looked like we were trending at 30 billion per month. So, and these are numbers because these are monthly numbers, right? So 10 billion difference even over, I mean, if you just multiply 10 times 12, that's like 120 billion per year. Now, again, the government finances are the budget deficit is so large. The budget deficit this year is probably going to be 2 trillion, right? So if you
Mhm.
really want to say like, well, yeah, it's not okay, 1.9 trillion versus 2.1 trillion. Okay, in one sense, it's just another part of the equation, but of course it is large numbers. So yeah, it just shows that there's this flow through, and the way economists like myself would think of it is um, I would think higher tariffs, of course, raise more revenue for the government, but it's coming essentially from the private sector. I mean, I don't have to tell
Right.
anyone
Yeah.
hear that, right? So, as an economist, I would think of it as a fiscal drag, right? And it's a fiscal drag that it went up last year and it's still there, but it is diminishing a little bit, and that's the uncertainty about future tariffs. What comes next, whether or not sort of are we just going to stay at this run rate of about 20 billion per month, or what? That's something that I don't have a crystal ball into.
That's great.
If only you did. Um, Thank you so much for those insights, Ryan, and especially, I mean, super new information, data coming out, just this morning. That's what we really try to provide to people on these webinars. So thank you so much for doing that and sharing all of that information. Appreciate folks like Ben said chiming in the chat as well. You'll probably hear from us, curious to hear a little bit more about some of your experiences as you're working on getting these refunds. Like I said, next week we will focus on China and the results of the summit and the impacts of that on trade. So look forward to you hopefully being able to join us right before the holiday weekend. Before you hit the road, you can squeeze in that half hour at 9:30 to get some updates. Again, if you'd like to connect more with Ryan or Joni with HSBC, feel free to reach out and we're happy to make that connection. And you can always reach out to us with any questions or thoughts, or even if you have topics that you'd like to hear about on these webinars that you feel are missing. We're always looking for more content. So again, thanks everyone for joining us. Look for this on our YouTube page and have a great weekend.
Thanks, everyone. Thanks, Ryan. Thanks,
Thank
Michelle.
you.